Good morning, everybody. Marty Mazora, November 21st, 2016. Going to be a short week for me this week, so this is my chance to do a video for you. Although I will be away from the office after tomorrow, but I will also have a connection. So if I have the opportunity or feel the need, you may hear from me during this week as well. Okay, so I've been talking a lot about sentiment because I think it's very important to get a feel for the potential for the market, at least in the near term, if not intermediate term. I can kind of gauge your expectations and keep you thinking clearly about the ups and downs of the market. Take a look at the screen, 46.7% bullishness, which is a monster spike from where we've been. We've been talking in the low 20s. So we had 2 weeks big moves. You can see it was almost an 8% move just this last week, week over week. A lot of that came from neutral, the neutral territory, if you will, some from bearish. But relative to what we've been seeing, that's a high level of bullishness. And what I've been telling you lately is I get less comfortable the more comfortable other people are. So here's how that looks on my chart. Just an absolute huge spike. I don't see that very often. I don't know if I've ever seen it quite that straight and smooth over such a short period of time. So what does it portend? What does history tell us about such big spikes in sentiment? Again, the higher the sentiment, the more, or I should say the weaker the outlook, which it's conventional wisdom, and has certainly been my experience. But what about these huge spikes over a relatively short period of time? Here from Bespoke Investment Group shows the last, looks like 25 years. And in that period captures all of the 20% increases in bullishness as they spike like they have recently. And as you can see, on average, and let's just jump out to 6 months, the average return 6 months later is actually 8.22% for the S&P. The median return 6.6 and up about 79% of the time. So these quick spikes don't necessarily mean that the market is going to fall out of bed immediately. And that would be common sense to me, because when sentiment is weak, you have a lot of people relatively liquid and out of stocks. And then when sentiment changes abruptly, you have a lot of people rushing to the market. And absolutely, the last few weeks, we have seen huge inflow into equity markets or equity funds, out of bond funds, in fact, and that's consistent with that spike. In my own analysis, what I like to do, and we have really jumpy numbers, and if I ran the actual week-to-week numbers here on a chart like this, you would just see it jumping all over the place. It would be hard to make sense of it. So what I did is I smoothed it out using the 20-day moving average. And so what it picks up are these longer-term trends, and this is the S&P 500. So this would be a smoother look. This would be bullishness moving up and staying in an upward pattern for a longer period of time. And so if you go back, and this is a 15-year chart, you can see here the 20-day moving average is moving up consistently, and you see the market running into trouble in 2001. You can see it happening here. Huge, elongated, extended move in bullishness here. We did have a move, and if you do that, the scale kind of doesn't help you appreciate that. That was close to a 10% decline, but of course it was just a, in my view, a run-of-the-mill correction. We had bullishness come back as the market came back, kind of had a dip there. Pretty nice long period of bullishness in that 45% range, and you saw a nice little blip in the market there. Then we had a nice rise in bullishness, which kind of set the stage. I mean, lots of things set the stage, and not because of the bullishness. But then we had that monster bear market in 2008. As the market came back, bullishness did as well, got above 40, stayed there for a while, and you see the market coming down. So folks, as you can see, these moves in bullishness, like the screen I showed you before, in and of itself is not a terribly bearish indicator in the near term. Here we had a real nice elongated move in bullishness on the 20-day moving average, and then we had that finally, after 4 years of no 10% correction, this was almost 20% here in 2011. We had two back-to-back, then we had bullishness dry up, and then we found our ways this morning on the S&P right back up against all-time highs. So while I'm going to continue to watch that closely and give you some commentary or my narrative on it, right now there's nothing in the historical context that would say we need to worry or fret over a looming downdraft to come. And of course, as long-term investors, we just tend to ride through these in good diversified fashion. Okay, so to kind of wrap it up, I don't want to keep you too long this morning. I'm gonna move in a different direction. Then I'm going to show you the short-term chart and talk about the technicals. This is the S&P 500 over the last 5 years. This is Europe, Australia, and Far East. Call that developed non-U.S. markets, and this is emerging markets. Clearly, over the last 5 years, it has not paid to have international exposure. If you are all developed, non-U.S. or all emerging, you actually lost money in emerging markets, and you just had very, modest returns in non-U.S., but very good returns over the last 5 years if you were just all U.S. Yes, using the S&P 500 as my proxy. When you bring in global portfolios, and all our portfolios are global, it's a much better look. This is the Morgan Stanley All World Index, which is more foreign than most of our portfolios, but it is still a bit more U.S. than foreign. So obviously diversification on a global basis helped, but still it was a tough thing. It was tough to do to beat in broad fashion just the U.S. market by itself. So what does that mean, if anything, when you have, again, 5-year period of underperformance in a couple of asset classes? Does that portend anything going forward? Well, in the book Quantitative Momentum, its authors did a lot of very interesting studies. And this one takes a portfolio that actually rebalances. Now, it rebalances a lot more often than most portfolios would be rebalanced, or should be rebalanced in my view, but it depends on your strategy. But this takes a portfolio every month and buys the losers of the last 60 months or the last 5 years. So a portfolio that is fairly actively rebalanced, but always rebalanced into the previous 60-month losing stocks. How did that portend going forward when you look at that all the way from 1931 back through 2014? Interestingly, when you look at the long-term losers, the annual growth rate was 14.3. So 14.3% a year when you bought the last 60-month losers versus 8.59% when you bought the last 5-year winners versus the 10% for the S&P and 3.5% for the Treasury bond. So how about that? So historically, if people did what people tend to do, and that is you look at a chart like this and you say, well, shoot, put me all here. I don't want to buy these losers. Well, if you had done that and rebalanced periodically, you actually would have had a losing portfolio compared to what you would have done if you bought the previous 5 years losers. So, folks, just another reason why, aside from really smart, fundamental, legitimate reasons to own non-U.S. Here's one just from a timing standpoint that it might not be such a bad idea. Plus, if you look at past tightening cycles, I did this myself, 6 months ago or so, it's been a while. But I looked back at the last 8 tightening cycles. So I took a period where the Fed started raising interest rates all the way to when they finished and they began lowering rates, and looked at the returns. The S&P 500 on average, or actually per cycle, because some cycles lasted more than a year, of course, but per cycle was up about 5.75%, 0.41% a month. So about a 5%, 4.8% annual return if you just times that by 12. Europe, Australia, and the Far East was up 18.85%. The MSCI emerging market, we can pick that up over the last 4 of the cycles, was up 31%. And then throwing in commodities, which tend to be the late cycle, inflation play, they've done very well as well. So again, history suggests that the last thing in the world we should do, despite current protectionist rhetoric and things that I'll have a lot to say about as the next few months unfold, the setup, as I've said, from a valuation, dividend, and so forth standpoint makes sense, but just from a timing standpoint, it makes sense as well. So we're certainly going to maintain our global allocation. Okay, so let's just finish up with the short term. Here's the chart of the S&P from this morning. These moving averages, the 200-day I've been paying a lot of attention to. That's a beautiful upward slope that says good things about the longer term trend. And the 50-day is actually turned and is moving in the right direction as well. So technicians would like this market based on the moving averages. We have had a really big spike from election day, so that's too steep a trajectory, so that definitely is going to flatten out. Markets, interestingly, trends tend to move at about 45-degree angles. And then we have this particular trend line that takes us to the Brexit low, and you can see as we came down and pierced it, it became resistant. So it was pretty solid resistance, and we had that pre-election sell-off. And then we came back, and we haven't been able to bump against that. So I see two short-term lines of resistance that technicians would be looking at. So this is that all-time high. So you've got the current trend, and then you've got the all-time high to bump up against. If we break through that with some momentum, that's going to be a very bullish sign, and we're going to be looking for more daylight up here. It would make sense to me, given and even the shape of this wedge here, that it would begin to break lower. I think there's a lot of people paying a lot of attention to this right now. If I threw in oscillators and so forth, it would probably show some waning momentum. I would not make a big bet against this market, folks, not in any way, shape, or form, and we're not short-term traders with our serious money anyway. So no, this is nothing we're going to jump in and do anything about within portfolios, of course, but I think it's always good, as many of you have commented to me, to give you some gauge on what the technicals are talking about the very near term. Thank you, folks, as always, for watching and listening. I wish you and your family a wonderful Thanksgiving. And, of course, you'll hear from me again very soon. Take care. Bye.